Welcome to Home to Resilient Wealth, the channel dedicated to empowering you with financial education. Today, we're diving deep into a fundamental investing principle, diversification. You've probably heard the phrase, don't put all your eggs in one basket. In the investing world, that wisdom is called diversification. Diversification means strategically spreading your investments across different assets, ensuring that a downturn in one area doesn't wipe out your entire financial portfolio. Instead of concentrating all your capital into a single stock or sector, you intelligently distribute it across various investment avenues. What exactly is diversification? It's about spreading your investments across different asset classes, so one bad day or even one bad year doesn't devastate your entire financial standing. This includes different asset classes like stocks for growth, bonds for stability, real estate for long-term value, and cash for liquidity. You also diversify across different sectors, such as technology, healthcare, energy, and consumer goods, to avoid over-reliance on any single industry. And don't forget different geographic regions, including the US, emerging markets, and global funds, to capture worldwide growth opportunities. Think of it like a buffet. You wouldn't just eat mashed potatoes. You'd grab a bit of everything to build a resilient and satisfying meal. Your portfolio should be the same. Why does diversification matter so much? Let's consider a scenario. If you put all your investments into tech stocks, when the tech sector booms, it's fantastic. But if it crashes, your entire portfolio could be devastated. Now, imagine you also own bonds, healthcare stocks, and international funds. Even if tech drops, your other assets may remain stable or even rise, cushioning the blow. Diversification helps you minimize risk without sacrificing growth potential, smooth out volatility when the market gets rocky, and ultimately, sleep better at night. It's not about avoiding risk completely. It's about managing it smartly to build a more resilient financial future. So, how do you actually diversify your investments effectively? First, diversify by asset class. This means balancing high growth, higher risk stocks with lower risk, income-generating bonds, and stable assets like real estate or cash. Second, diversify by sector. Invest in multiple industries, not just one. Tech, healthcare, energy, finance, and consumer staples all perform differently in various market cycles. Third, diversify by geography. Include international and emerging market funds to capture global growth, as different economies thrive at different times. Fourth, diversify by investment type. Use a mix of individual stocks, exchange-traded funds, and real estate investment trusts to broaden your exposure. Can't decide where to start? A total market index fund or a target date fund can provide built-in diversification right out of the gate, simplifying the process for beginners. Now, a common question, can you over-diversify? Yes, you can. If you hold too many similar investments, you end up with what's called diversification. This dilutes your returns without significantly reducing risk. For example, owning 10 different S&P 500 ETFs isn't diversification, it's just repetitive. The goal is balance, not overload. Your diversification strategy should also evolve with you as you progress through different life stages. In your 20s and 30s, you might focus on more stocks and growth-oriented investments to maximize potential returns over a longer horizon. As you move into your 40s and 50s, you might add more bonds for stability, balancing growth with capital preservation. And in your 60s or near retirement, the focus shifts to capital preservation and income generation, with a higher allocation to less volatile assets. Remember to rebalance regularly to ensure your mix continues to fit your goals and timeline. Diversification isn't a set-it-and-forget-it strategy. It's a living, evolving plan. For beginners, here's a simple diversified setup to get you started. 40% total stock market ETF, 20% international stock ETF, 20% cash or bonds, 10% in a bond ETF, and 10% in real estate. Alternatively, a target date fund based on your retirement year automatically adjusts its asset allocation over time, providing hands-off diversification. While diversification doesn't guarantee profits, it is one of the most powerful tools long-term investors have to protect themselves from putting all their faith and money in one place. If this video clarified things for you, please like and subscribe to Home to Resilient Wealth for more investing insights. And drop a comment below. What does your portfolio look like? Next up, we'll explore the magic of compound interest. You can also download our free beginner portfolio template from the description below.